Good morning. Thank you for joining Armanino this morning for our webinar, Enable Your CFO Evolution with a Finance KPI Dashboard. My name is Mary Tressel, and we're very glad to have you here with us. To get started, I want to just bring you some pointers about using your webinar pane. If your webinar pane is minimized, simply click on the orange arrow in the upper right-hand corner of your screen, and it will maximize and open up for you. You can enter a question for our presenters at any time throughout the webinar, and we will answer those questions as time allows at the end of the webinar. And if you've got a question and we run out of time, we will make sure that our presenters do respond to you via email. Additionally, please make sure that your audio settings are set correctly. If you're calling in by telephone, click the telephone button. If you're using your computer, microphone, and speakers, please select that button. This will help eliminate any echo sounds during the webinar. I'd like to introduce our first presenter. John Horner is partner for Armanino's business intelligence practice. He's got 10 years of industry experience and many years of consulting experience in best practices, especially for data warehouses and business intelligence implementations. He's worked in a variety of industries, including retail and distribution, consumer product goods, high-tech, manufacturing, professional services, and utilities. Our second presenter is Jeffrey Wayong, director of our BI practice. He introduced the ClickView business discovery tool to Armanino clients in 2010, and he also helped Click to develop the first ClickSense certification program. So Jeffrey has managed Microsoft Dynamics GP, AX, and CRM implementations, as well as our high-performing business intelligence technical team. And with that, I'm going to turn it over to John Horner.
All right, thanks everybody. Thanks Mary for that, and welcome everybody. Today we're going to walk through an introduction. Jeffrey Wayong will do the first part of this presentation, introduce you to KPIs, give you some definitions, characteristics, and some examples, and then walk through and talk about how KPIs can be aligned to your firm's strategic objectives. Again, financial KPIs, operational KPIs, talk about some different examples there, give you some background, and really just help position this in terms of the ongoing theme of our CFO Evolution here. I will then jump back on and walk through, really talk about the anatomy of a KPI. What are all the things that make up a key performance indicator? And really talk about the differences between what might be considered a KPI, key performance indicator, versus other measurements that we might measure within our daily lives, which things to perhaps focus on, and which things to look at as a subordinate kind of measure that might help in the KPI. And then we will kind of close out with an interactive example demonstration, if you like, of an example KPI dashboard that we've put together, and walk through that environment for you.
All right. So first of all, I think I would like to draw on some of the background here. We are doing a continuing theme throughout the organization. For the past couple of years, we've been doing surveys as part of our CFO Evolution. And one of the top things that C-level executives have in mind is making better decisions with better data and better insights. And that obviously have gained tractions. And in 2014, early last year, we put together a white paper to help provide some guidance and directions. Titled Mastering Reporting Analytics. And then in summer last year, we actually put together an executive roundtable where we invited a dozen of executives from a variety of industries to join here at our office to get them introduced to each other, as well as sharing some of their best practices, some of their thoughts, what's going on in their organizations, as well as their visions, their predictions, and what they're thinking along the line there. So that would be the basis of our webinar today. But I would like to start from the beginning. What is actually a KPI, or key performance indicators? There are a lot of definitions out on the internet. and you can see some of them listed here, but the gist of it are pretty much the same. It's a way to measure company's success as well as its progress to success. So it's measuring three different things: how successful is a company, and also the progress to get there. And the other thing to point out, what makes a KPI is the word key. So we're going to touch upon this throughout the webinar here to identify what is the difference between key and what is just performance indicator or just performance metrics. So with that, I'm going to start describing some of the characteristics of a KPI. There are many of them here, but we were able to distill some of this, combining with the feedback as well as the discussion points that came across from the executive roundtable. So the first thing is standardize. This is truly what makes a KPI a KPI. So what that means is standardized means it's consistent and has to align with company business objective. Every organization has a business objective or goals that they're going to strive for that year or for the near term, and the KPI has to be consistent and also align specifically to that objective. It also should provide a 360 view of your business. Since it measures the performance, it measures the success, whether we get there or close to it. So the second thing is one of the characteristics of a KPI, it has to be easily understood by everyone. If it's not easily understood by everyone in an organization, then obviously there's no use, because it's not really giving them a good performance metrics for them to track against. So one of the things that we're going to see as well as part of a good implementation of a KPI, it's actually creating a KPI that understood not just by the executives, but it's also a KPI that would be well understood by all layers of their organizations. So it's something easy and simple for them to understand, so they understand as well how they can make an impact. The third characteristic is measurable. A KPI not only need to be understood, but it has to have a good data existence to support the KPI. And in some cases, not just the existence that matter. In some cases, it's the accuracy of the data that provide that KPI, the supporting information. So it also provides traceability. If there is any question that comes up with a particular KPI, there is a way to drill down a little bit further into the data. So that is definitely one of the key things that we're going to see in a KPI implementation. The fourth item here is a KPI should be also actionable. So now it's been understood by everyone. It's measuring the right information, but it needs to be clean enough for everyone to be able to draw some conclusions and make decisions out of it. So that's the very nature of a KPI. It's not just tracking performance, but making sure that people have a way to react against those informations. The next thing is something that not as common that people didn't realize when they implement a KPI, which is a KPI is such an important performance metrics that it needs to have someone who's managing it. Someone needs to be accountable to make sure that it's tracking the information properly, and it has to be also reacted accordingly. So when a KPI is providing some insights, they need to be able to alert the appropriate team or stakeholders to make the proper decisions in terms of actions. So this is sometimes in a KPI world is called a KPI Steward, and it can be a person or it can also be a team. The next one here is the frequency. A KPI is not something that you just look at once a year. A KPI typically is something that you're going to look over time, and what we typically come across, it could be weekly, monthly, or quarterly. But this is not a hard, fast rule for everyone. There are some organizations that are looking at our KPI on a daily basis, but what we typically come across at the same time, when it's daily, sometimes it might not be a KPI, but it could be just a regular operational metrics. And we're going to touch upon that again a little bit later as part of the illustration as well. And I'm leaving this one characteristic behind as the last one, which is has a target. A KPI won't be a KPI without the proper context. So a KPI needs to have a target, and that target could be last year's performance. It could be a budgetary numbers. It could be what you're trying to attain in business goals. So a KPI is very important to have a target, because without it, as an example, an organization could have a goal of profitable growth. But if it's tracking the company to have a profitable growth of 10%, we won't know without the proper target and context whether that 10% is a good thing or is a bad thing. It's highly dependent on that organization and what they're trying to attain. So those are some of the characteristics of a KPI. The next one here, I'm just going to share a little bit more of some of the sample KPIs that we typically come across. Again, this is not hard, fast rule for your organization. It's highly dependent on what you have in mind for your organization, and this could be changing throughout the industry. So a few things here to call out. Gross and net profit, that's something that's very common, along with EBITDA for a lot of organizations. But some of the things here, like debt to equity ratio and debt to asset ratio, stock prices, earnings, and cash flow, those are typically synonymous to a lot of public companies where they're trying to track how they're doing in the market. But there are also some KPIs involving internal processes, things such as cost of goods sold, very synonymous to a retail industry, cost of labor, headcount. Those are typically related to a service industry or a food industry, where they want to try to see the breakdown of the labor, because that's part of the highest cost that they have to incur. Cost of sales, travels, anything related to commission base, anything related to the mobile workforce, that's something that they track pretty heavily, as well as revenue by product line, by the different source of channel, as well as by the geolocations. So those are obviously some of the typical one that we come across. Some of the other examples here in relation to customer service, for example, customer acquisition costs or turnover rate, that's very closely related to a SaaS-based company. Returns, warranty, repairs, complaints, and legal costs, that could be very well related to manufacturing type of companies. Employee relations are probably applicable to a lot of organizations, but very important and key to a lot of service organizations, as well as professional service arm in a software company, for example. So with that, I'm going to turn it to Mary.
So we have a polling question today, and we wanted to get your input. Which KPI topic is most frequently requested in your organization? Are people asking for financial KPIs, sales, internal processes, customer service, or employee relations? So there's not one right answer. We're just trying to find out of our audience here what type of KPIs you're asked about most frequently. So we have a few of you have voted. We're going to leave the poll open for about 10 more seconds. If you can let us know what you spend your time or your staff's time on developing reports around and getting those distributed out to management, that would be great. Okay, with that, we have about 75% of you have voted. We're going to close the poll and share our results with you, and Jeffrey will go over them.
Thank you, Mary. So the result is very good in the sense that it reaffirms what a lot of organizations are really looking for. The top things that we also come across is financials, and you guys voted for 56% of you guys are looking for financials most of the time, and 30% of you guys are looking for sales. And those are the two top areas that we typically come across when we actually talk to an organization. So this is very consistent with industry and how everybody felt what they should be tracking when it comes to KPI. So I'm going to do one other thought and leave behind here before I turn it to John for further demonstration. So a few things, if you are looking to implement a KPI scorecard or a KPI in your organization, or maybe you are trying to re-jumpstart the rebuilding of your KPI. So there are a few things to consider, but these are the top 3 things that we typically come across. So first of all is distribution of a KPI. A lot of the time, everyone looking for a self-service. That's the ultimate goal for a lot of organizations. whether that might be served through a portal, maybe that's served through a dashboard, or a report that was stored somewhere on the network. But self-service is something that everyone is looking for. But at the same time, there are also organizations that are looking to distribute this KPI results through emails, through email attachments, or through other things. But just trying to draw some experience from our own organizations, we internally have the KPIs tracked in multiple different ways. So it's a combination, if you will. So the first way is we have our self-service dashboard that tracks the KPI for the organizations. Everyone can get into the dashboard and they can kind of look at how we're doing as a company on a regular basis. But at the same time, our company also does a quarterly internal calls that on that calls, the executive will also unveil some of the KPIs that we need to track to be aligned well with our business objective for the year. So that's just a little bit about how we're doing within our organization. But what I have to say is it is a change of culture, and what is right for your organization today might be also different coming down the line, depending on how the culture evolves. The other consideration you need to take into account is also the number of KPIs. In a lot of organizations, this is also closely related to the objective that you have. Again, this highlights the point of what is key, as in key in KPI, as well as just a regular performance indicators. What we come across from our discussion at the roundtable, 1 is definitely not enough, and 100 is way too many. So what the group felt, anything between 4 to 10, it's something that would be right for majority of the organizations. But again, this is not a hard fast rule. Every organization have their different objectives, so it has a different number of KPIs that you should be tracking. But it should be, the set should be representative enough of the company's health and how they're doing overall in the 360 view. Maybe a little bit on financials, a little bit on sales, a little bit on different areas. The last thing here is very important as well, which is a KPI reevaluations. What that means is your company continue to evolve, whether that through the different business goals that you have, as well as your culture and the dynamics of your organization. So the KPI itself needs to be reevaluated every year. Is that effective enough? Is it an efficient way to measure success and progress to that success? So this is something that would be part of the responsibility of that steward that we mentioned earlier as part of the accountability, is making sure that this is continuing to get adjusted. If this is not the right KPI anymore to track against our business goals, it has to be adjusted or changed accordingly. So with that, I'm going to turn it to John Horner, who can provide you a little bit more illustrative example of a finance dashboard.
All right, thanks, Jeffrey. That's good. I think when we put together the structure for this webinar today, we really wanted to cover 2 things. One was to review the findings from that roundtable last year that we had. I think Jeffrey's covered a lot of the points there. And secondly, really to bring some of that to life, provide an illustration of how you might take some of those findings, how you might use some of those findings within your organization in your daily lives, whether that be whether you are a CFO or a controller or one of the stewards that we talked about of the KPIs. And really that's what I want to do now, is kind of switch over to walking through an example, an illustration, if you like, of a KPI dashboard. So you guys are now, we've kind of switched off the PowerPoint now. You guys can see here an example of a KPI scorecard that we have put together. This is really a sales KPI scorecard, sales-related KPI scorecard, and it's based upon a fictitious company. The company kind of sells bikes across the world, across a global environment. And so you can see the scorecard here. We have some different sections. We have the KPI scorecard table at the top here. We have some KPI trending, and then a geographical visualization of the KPIs in the bottom right sector there. Before I kind of walk through and show how this can be used and how you might use this in your daily lives, I do want to take some time here to walk through the anatomy of a KPI, if you like. Jeffrey mentioned some of the key characteristics there in the first part, and I want to kind of walk through and touch upon some of those. I think, you know, a lot of the time we will talk about KPIs with people, have discussions on them, and sometimes I think we forget that it's not that simple to put some of these things together, in the sense that there are a lot of different things that are required in order to really perform good KPI analysis. Of course, you can always measure actuals, so that piece is easy. Usually it's easy to find a target, but really to get to the depth and cover all of those characteristics and you know, have an organizational structure that supports these KPIs that roll up to your strategic objectives does require a little bit of thought. And so what we'll try and do today is walk through some of those examples. So you can see here in the example we have that Jeffrey touched upon it in his walkthrough. There's different scenarios here. In this particular example, we're going to stick with this kind of same period prior year example, but clearly some of your KPIs might relate to budgetary numbers. They could be relate to reforecast numbers that happen on a regular basis, or they could be related to a prior period. So instead of looking at the same period last year, you might be looking at the previous quarter. If you have a fast growth business, then sometimes that's what you look at rather than the prior year. So that kind of gives you an idea of some of the different scenarios that you might want to look at in terms of what you are actually measuring your actual against. What is your target going to be based upon, if you like? In this case, our target is going to be based upon the same period prior year. Now, from a period perspective, what is it we're looking at here? Jeffrey talked about the frequency of the KPIs and what you want to look at. So again, in this particular case, we're going to look at a particular period. In this case, you can probably see we're looking at December 2012 as a periodic view of what we want to look at. But we may also want to look at that from a year-to-date perspective, quarter-to-date, down to week-to-date, and many different views. So again, in order that the scorecard supports those options, then there's some data that's required in order to be able to do that analysis, different periodical analysis. Okay, so walking through the scorecard here, if you like, let's just kind of walk through each piece. In this case, we've kind of given each KPI a code. We're using 12 in this example. I think Jeffrey touched upon, you know, what's the right number of KPIs, somewhere between 4 and 10. In this case, we put down 12 in this example. But certainly you don't want too many of these things, otherwise the whole part of the KPI that is key becomes too diluted. So again, we can, whether or not these should be considered KPIs, we're not really kind of getting into whether these are valid KPIs or whether they might be considered simple metrics that support KPIs at this stage. They're just examples for this particular webinar. But you can see that each one has a name and a description. We've tried to group some of these together, so you might consider these things even within the fact that we've already said this is really more of a sales KPI scorecard. Within that sales KPI scorecard, perhaps some of these KPIs are grouped together for different reasons. Again, not suggesting that this is the right way of grouping or the only way of grouping, just really to give an example of how you might do that. We then have the actual number here, whether that be dollars, whether it be percentages, whether it be an integer, whatever that might be. That gives you the actual number that you have for the particular scenario, for the particular period. And then, as Jeffrey mentioned, we have the target number. It's very important that you have that number to understand how are you actually doing actual versus target. We then have the delta here, the difference between the actual and the target, and then two percentages really. I kind of put both of them in. I don't know that you would necessarily need both, but it was just to kind of explain that really the some people report the delta differently, whether you report this as an 88.9% increase over the target or whether it's a 188.9% attainment. So different ways of viewing it, that's fine. It was just really to call that out. Now on the period status, we see a lot of this. It's kind of visual indicator to recognize whether or not the delta, if you like, is good, bad, or indifferent. We hear a lot about kind of red, amber, green. In this case, we've actually added a fourth just to work through this example. But let me walk through some of the complexity here. This period status can be one of the complex things that needs to be really thought about in this scenario. So you'll see next to it that we have this warning threshold. Again, in this example, we're using a kind of global warning threshold for each of these KPIs. It's more than likely that some of these would differ across the KPIs, and it's also likely that as you drill into more detail, perhaps by region or different areas, again, that these thresholds may change. So that's true, and we need a way of kind of managing that data set behind the scenes. But in this example, what we're using is this threshold to determine whether or not this period status should be blue, which we consider very good, green, which we consider good, amber or yellow, which we consider a little bit below par but not too bad, and then red, which is well below par, if you like. And how this works is if we consider 100% being green, then as soon as you hit that kind of 100% attainment, then your period status might turn green. If you are 15% over that, then you would turn to blue, so that would be exceptional circumstances. If you are between 85% and 100%, you would be in the amber or yellow status, and if it's below 85%, then you would be in the red status. So again, just to kind of call out that behind the scenes there is a little bit of data that needs to be looked at here in order to get to those statuses. We have a kind of really just pointing this out that, and we have an example. It may be a kind of silly example in this case, but of course we need to understand that some KPIs being above your target is not a good thing. So typically on costs, for example, in this case it's cost of goods sold, but if your costs are above the target cost that you have, then typically that's not a good thing, and so you want to kind of reverse the sign and make sure that you get your blue, green, amber and red statuses accordingly so that people understand what is good and bad. This is it's really more for demonstration purposes. I don't know that it's a good example to show COGS since we blew sales out, COGS is higher, and therefore I would perhaps argue whether or not it should be red. Perhaps it shouldn't even be a KPI at all. So just to point that out. Now Jeffrey talked about the what is key and how do your KPIs evolve over time. And so the concept of weighting or prioritizing your KPIs, again here we've kind of given a flat weighting to each of these, suggesting that they're all equally important. The reality is you probably wouldn't do that, but you might want to give some of these KPIs more importance than others, and therefore you can kind of change those weightings and change those priorities within your data set, and that would then get reflected within this environment here so that people could see which ones were perhaps weighted higher than others or had a higher priority than others. we talked about the key, kind of putting the key into key performance indicators. At the moment, we've got these all labeled as key in this example. Again, it's perhaps true that not all of these would be KPIs in an organization. We've just chosen these as examples. We can actually go in and switch off this and kind of filter this so that we're not just looking at key performance indicators, because sometimes you do want to look at something that is a measure that makes up a key performance indicator, so you can get to see some of the reasons behind a key performance indicator. And I'll come on to that when I kind of walk through the example. And then finally, we have this KPI Steward here. This, again, just fictitious examples, but it allows us to see who is actually looking after that KPI and who might I want to talk to if I have a question about overperformance, underperformance, or continuously good performance, for instance. So it's not necessarily used to be a stick to beat people with, and hey, I'm going to call up John Horner here and see what the heck's going on. But it does give you, give people that accountability around the KPI, and it also gives your organization, in terms of this scorecard, the ability to see who it might be I want to talk to and who might I share a conversation with. So really that kind of walks through a lot of the things. Now down on the bottom, what we've started to do is, you can see here that we're focusing, we have this KPI focus on the sales amount, for instance. I can change that focus, and it simply focuses on a different line, and you may or may not have seen, but the trends down the bottom, which is an actual versus target, changes accordingly. So again, if I perhaps move to the gross margin or to the ASP, then you can see that change more easily. So in terms of how we use this on a daily basis, you can now begin to focus on different areas, and as Jeffrey mentioned, delve a little bit deeper. It's not good enough just to know that my ASP may be overperforming or whatever it is that I want to look at. I need to be able to delve deeper, otherwise it has kind of limited use, and what you end up doing is going back to this KPI Steward and asking the questions of why and what's behind it and what are some of the reasons, and that person then has to go digging around and do all their analysis and kind of answer the question. So really, from the self-service perspective that Jeffrey talked about, this allows you as a CFO, controller, whatever it is, to do a little bit of that digging before you get to that point. So for instance, I might want to look at the actual trend of sales units. I might want to look at, again, at the moment we're showing just KPIs. I have a selection filters thing that I can kind of bring up here, and you can see here that we have selected is key equals yes. Well, if we take that off and look at all of the other metrics that might support some of these KPIs, then I can now see that when I've selected sales units here, I have a couple of other metrics, and again, these are just kind of examples, but a couple of other metrics that make up sales units. So you can imagine that behind each one of these KPIs might be 3, 4, 5 different supporting metrics. We don't consider them key, but they do, of course, impact the sales units number or whatever KPI you're looking at, and may then offer you a little bit more supporting information about what is the reason that that KPI is performing or not performing. Is it because you've had too many returns? Did you sell less than you thought you were going to sell? What are some of the reasons behind that? So we have that kind of hierarchy of measures, if you like, that build up and drive up towards the KPI. I'm going to go back to my kind of bookmark and remove the supporting KPIs for a second. Hopefully that kind of gave you a flavor of what you can do, and just walk back through an example here. So again, let's focus on sales amount here. Down the bottom we have an actual versus target trend, so we can see how we're doing over time. We can also see this as a kind of win-loss trend chart, so instead of graphing the two things together, simply graph the difference between the actual and the trend. So we can just flip to the win-loss trend for that. This gives you the gap. We can see then that we have, for instance, even though we're doing very well in terms of sales amount in this example, there is one month where we didn't do particularly well. It wasn't too bad, to be quite honest. We're only $47 down, which is, in the grand scheme of things, isn't bad. But in this example, we can then pick on that example, if you like, and look at March and zero into March and start to look at what were some of the things that made up that loss in March. What was some of the supporting data that feeds that? And I think back to Jeffrey's point when he walked through this, this is where having supporting data behind the KPI available in your self-service scorecard enables you as a user, whether you be a CFO, whether you be an analyst, to go and delve a little bit deeper. Now, you may not want to, but if you call the steward up and ask them from a high level to go digging, then certainly that steward will want to be using the same data that you're using. And so from that perspective, having this kind of one version of the truth and a joined up approach. Now, what we can also see then is now we have a country analysis of the sales amount figure that is down in March. So we can see now that the KPI scorecard has changed a little bit. We've now got a yellow warning light for March because we weren't above the what we wanted. We can now sort this if we like. We can sort it by delta and start to look at if we sort it in negative order. Okay, well, what was was there one country? Was there multiple countries? What was the reason for that delta in March? And we can see that United States stands out. First of all, it's the bulk of our transactions, so it represents almost 50% of our sales, but it also was where the biggest deficit was. So we can now drill a little bit deeper into the United States. Now we're looking at the same kind of analysis for the United States, and we can look at that from a state-province perspective. So perhaps we want to look at which states were not performing there. So we might want to pick on the top three here, Nevada, California, and Utah. They seem to contribute an awful lot of the deficit. So let's look at those particular states. And depending upon your data, you can then really drill and analyze by any particular data set that might be available in your data set. So we can take a look at those three states. Was it across all product categories? Was it one product category? In this case, it was the bikes product category where the entire loss was felt. Actually, in those three states, all the other categories performed okay. So again, we can kind of continue down our journey of really learning more about what it is, what's the reason behind the difference between our actual and the target, and eventually get to the point where you get to the real bottom end of the analysis. Okay, so hopefully that gives you a flavor of how this can be used. I do want to kind of walk back through a little bit here and just kind of get back to the point where we were looking at the United States, for instance. So I'm going to kind of walk through this again, but do a slightly different analysis. I'm going to look at sales amount again.
John, while you're getting that ready, I just want to remind the audience that you can enter in any questions you have about KPI dashboards at this point, and we will answer them at the end of the webinar.
Okay, perfect. Thanks, Mary. Okay, so I'm going to kind of walk back through the same things, same starting point, just a slightly different scenario here, just to give you a flavor of some of the things that we can do here. So again, we looked at March, for instance, so we can kind of drill down the same path. Look at our countries again, look at the country analysis, view United States, but this time come back and say, okay, well, I am interested in learning more about the United States, but how did the United States perform across the entire year? Was it just March? And previously we were looking at the whole global organization, so we can come back in here deselect March from our view. So we're now looking at the entire year, and we can see that that the United States actually had a couple of blips, or 3 blips on the radar, March, August, and November. And so again, to the point, we can kind of delve deeper and go further into our analysis, look at those other periods, see whether the United States was the only region that suffered the deficits in those periods, and so on and so on. Again, really this kind of capability, this self-service capability that you would have, depends very much upon the data that you have that supports these KPIs. But hopefully that gives you a good feel of the scorecard that we have, the example scorecard that we have here. And really, just to kind of reiterate, we wanted to cover today the walking back through some of the definitions and the characteristics of KPIs. Revisit our the roundtable that we had last year, present some of the findings that we got from that, from our customers, and some of the great discussions that we had there. Help you understand how you might align some of these KPIs with your firm's strategic objectives, and by giving you, an insight into the anatomy of a KPI, if you like, just walk you through some of the considerations that you might need to look at when we're building this together, and then give you an example of, well, what might it look like once we've kind of gone through that process together, and how might I use that, how might our team use that, how might our organization use that on a daily basis. So I am going to hand back to Mary, I think, just to go through the Q&A session.
Yes, so thank you, John and Jeffrey, and we have gotten a couple of audience questions. The first is an interest in which data sources could make up a KPI dashboard. Would it be kind of an API to a cloud-based system like Salesforce.com or NetSuite or QuickBooks? The question continues on, where does the data live? Do you have a single data source or multiple data sources?
Okay, thank you, Mary. So definitely, I think those are valid questions, and what we come across is a variety of the ecosystems that we typically see with our client base. It's very rare to be able to find one single system where we source a lot of the or all of the KPIs that we need to provide answers to or to display. A lot of the times it is a combination of different systems, and you should probably be looking at the KPI based on that perspective as well. So just kind of draw some correlation to what we have internally. Our KPI internally, we actually derive that from, I would probably say, 4 different sources. One of them is our time and billing system, which is a proprietary system. We also have our ERP system, which is our Microsoft Dynamics. We also have our CRM system, as well as some budgetary number that comes from Adaptive. So it's a variety of different systems, and it's not just on-premise, but it's also a cloud-based system. So that's a very common to see multiple different data sources to provide that 360 view of the KPI for your organization. Hopefully that answers the question.
Yeah, and then the next question was, how many years of data can be kept in the system for KPIs, and can you import or link the data from other systems to this system? So you sort of answered that one, but how about the length of time for the data?
Okay, so that's another good question. I think a lot of organizations typically prefer to see a couple years of data for their KPI tracking, primarily because they want to see how they're doing year to date, for example, with the same period last year, or how they're doing the last 2 years. But I don't think there is a particular limit how much data you can put in your KPI tracking, if you will. If you'd like to see the history or the trending, I think it's pretty pertinent. Again, trying to draw on our own experience here, we internally have data since '98. So on our KPI dashboard, we actually have data since '98 through today. It's not that everybody would be looking at what happened in '98, but it's certainly there for them to get that information. And this is also consistent with some organizations where we have another client that was interested in in getting KPI to be consistent because they actually provided a KPI, but then they have a change of ERP systems. And they want to make sure that the KPI stays intact. So during that transition, we actually were able to bring in the history from the old ERPs and then stitch that partial data for the year with what's happening in the new ERP. And that makes a complete view for the executive and throughout the organization. They'll be able to see continuing history from the KPI display perspective, even though the data behind it is actually coming from two different systems. So again, hopefully that gives you some spectrums, if you will.
Great. Okay, and one more question. What's the typical length of time to build out a CFO KPI dashboard? Obviously, it varies from client to client, but what would you say is a typical time period?
Yeah, thanks, Mary. It is a difficult question. Obviously, we would really need to take a look at, what systems, what data do you have? Also, what's the maturity of where you are with your KPIs? Do you have them all defined, or are we needing to offer assistance in putting that together? I think assuming that you have some of your KPIs well defined, and you have the data readily available, then this can be certainly done in a matter of weeks, not years, or months. But it really just depends on what you've got available. It's such a difficult question to answer right now. Of course, we'd be more than happy to try and delve a little bit deeper and get some more details and find out.
Great. Okay. Well, I think that's it for our questions. Again, we'd like to thank the audience for joining us today. And as you can see, we have John and Jeffrey's contact emails up on the slide, and their phone numbers if you'd like to reach out to them. And if you have any further questions in the exit survey, we will answer those as well. But we would greatly appreciate if you filled out the survey so we can always improve our presentations for our audience. And thanks again for joining us.